In this chapter, we look at some common forms of compensation in which the amount of the compensation employees receive is tied to the market price of the company's stock. We will see that these share-based compensation plans, stock awards, stock options, and stock appreciation rights, create shareholders' equity, which often affects the way we calculate earnings per share. Specifically, we view these as potential common shares along with convertible securities, and we calculate earnings per share as if the securities already had been exercised or converted into additional common shares. Employee compensation plans frequently include share-based awards. These awards are forms of payment whose value is dependent on the value of the company's stock. These may be outright awards of shares, stock options, or cash payments tied to the market price of shares. Sometimes only key executives participate in the stock benefit plan. Typically, an executive compensation plan is tied to performance in a strategy that uses compensation to motivate its recipients. Actual compensation depends on the market value return of the shares. Although the variations of share-based compensation plans are seemingly endless, each shares common goals. Whether the plan is a stock award plan, a stock option plan, or stock appreciation rights, SARs, or one of several other similar plans, the goals are to provide compensation to designated employees while sometimes providing those employees with some sort of performance incentive. Likewise, our goals in accounting for each of these plans are the same for each. 1, determine the fair value of the compensation, and 2, to expense the compensation over the periods in which participants perform services. Executive compensation sometimes includes a grant of shares or stock or the right to receive shares. Usually such shares are restricted in such a way as to provide some incentive to the recipient. Typically, restricted stock award plans are tied to continued employment. The two primary types of restricted stock plans are restricted stock awards and restricted stock units. In a restricted stock award, shares actually are awarded in the name of the employee, although the company might retain physical possession of the shares. The employee has all the rights of a shareholder, subject to certain restrictions or forfeiture. Ordinarily, the shares are subject to forfeiture by the employee if employment is terminated within some specified number of years from the date of grant. The employee usually is not free to sell the shares during the restriction period, and a statement to that effect often is inscribed in the stock certificates. These restrictions give the employee incentive to remain with the company until rights to the shares vest. The compensation associated with a share of restricted stock is the market price at the grant of the unrestricted shares of the same stock. This amount is accrued as compensation expense over the service period for which the participants received the shares, usually from the date of grant or when the restrictions are lifted, the vesting date. Once the shares vest and the restrictions are lifted, paid-in capital restricted stock is replaced by common stock and paid-in capital excess of par. The amount of the compensation is measured at the date of the grant, at the market price on that date. Any market price changes that might occur after that date do not affect the total compensation. An increasingly popular variation of restricted stock award units, RSUs, in fact, RSUs have become a much more popular form of compensation than their restricted stock award cousins. A restricted stock unit is a right to receive a specified number of shares of company stock. After the recipient of RSU satisfies the vesting requirement, the company distributes the shares. So, like restricted stock awards, the recipient benefits by the value of the shares at the end of the vesting period. Unlike restricted stock awards, though, the shares are not issued until the time of the grant. Delaying the increase in outstanding shares is more acceptable to other shareholders. Terms of RSUs vary. Sometimes the recipient is given the cash equivalent of the number of shares used to value the RSUs, or the terms might stipulate that either the recipient or the company is allowed to choose whether to settle in cash or stock. As part of the share-based compensation plan, Apple Inc. provides compensation to executives in the form of RSUs, restricted stock units, as shown in this illustration. When RSUs is considered to be a liability, we determine its fair value at the grant date and recognize the amount as compensation expense over the requisite service period, consistent with the way we account for restricted stock awards, RSUs, and other share-based compensation. Here, no journal entry is passed on January 1st, 2016. The total compensation is the market value of the shares, $12, times 5 million shares. The total compensation of $60 million is accrued to compensation expense over the 4-year service period. However, because these plans are considered to be liabilities payable in cash, the credit portion of the entry we recognize compensation expense each year is to a liability, restricted stock account, and it's necessary to periodically adjust the liability and corresponding compensation based on the change in stock's fair market value until the liability is paid. For December 31st, 2016 through 19, the company debits compensation expense for $15 million, calculated as $6 million divided by 4, and credits paid-in capital restricted stock for the same amount. When restrictions are lifted, paid-in capital restricted stock is replaced with common stock and paid-in capital in excess of par. Here the company debits paid-in capital restricted stock for $60 million, calculated as 5 million shares times $12, and credits common stock for $5 million, calculated 5 million shares times $1. The difference is recorded as a credit to paid-in capital excess of par for $55 million. Concept check. Concept check. Stock option plans give employees the option to purchase a specified number of shares of the firm's stock at a specified price during a specified period of time. One of the most heated controversies in standard-setting history has been the debate over the amount of compensation to be recognized as expense for stock options. At issue is how we value the stock option is measured, which for most options determines whether any expense is required. Historically, options have been measured at their intrinsic value, the simple difference between the market price and shares and the option price which they can be acquired. For instance, an option that permits the employee to buy $25 stock for $10 has an intrinsic value of $15. However, plans in which the exercise price equals the market value of the underlying stock at the date of grant have no intrinsic value and therefore result in zero compensation when measured this way, even though the fair value of the options can be quite significant. We measure compensation as the fair value of the stock options at the grant date and then record the amount as compensation expense over the service period which the employees received the options. Estimating the fair value requires the use of one of several option pricing models. These mathematical models assimilate a variety of information about a company's stock and the terms of the stock option to estimate the option's fair value. The model should take into account the exercise price of the option, the expected term of the option, current market price of the stock, expected dividends, expected risk-free rate of return during the term of the option, and the expected volatility of the stock. In the illustration, fair value is estimated at the date of grant. On January 1st, 2016, no journal entry is recorded. Total compensation expense is calculated by multiplying the estimated fair value per option of $8 by options granted of $10 million. This gives us a total compensation of $80 million. The total compensation is to be allocated to expense over the 4-year service, the vesting period, 2016 to 2019. By dividing $80 million of the total compensation by 4 years, we get $20 million of compensation expense per year. On December 31st, 2016 through 19, the company debits compensation expense for $20 million, $80 million divided by 4 years, and credits paid-in capital stock options for the same amount. Concept check. If previous experience indicates that a material number of the options will be forfeited before they vest due to employee turnover or violation of other terms of the options, we adjust the fair value estimate made on the grant date to reflect that expectation. For instance, if a forfeiture rate of 5% is expected, Universal's estimated total compensation expense would be 95% of $80 million or $76 million. In that case, the annual compensation expense for the illustration would have been $19 million, $76 million divided by 4, instead of $20 million. Here, for the year 2016 and 17, the company debits compensation expense for $19 million and credits paid-in capital stock options for the same amount. Universal should adjust the cumulative amount of compensation expense recorded to date in the year of the estimated changes. Suppose, for instance, that during the year Universal revises its estimate of forfeitures from 5% to 10%. The new estimate of total compensation would then be $80 million times 90%, or $72 million. For the first 3 years, the portion of the total compensation that should have been reported would be $72 million, 3 divided by 4, or $54 million. And since $38 million, 19 times 2 of that was already recorded before the estimate change, an additional $16 million would now be recorded in 2018. Then if the estimate isn't changed again, the remaining $18 million, 72 minus 54, would be recorded in 2019. Here, for the year 2018, the company debits compensation expense for $16 million and credits paid-in capital stock options for the same amount. Similarly, for the year 2019, the company debits compensation expense for $18 million and credits paid-in capital stock options for the same amount. The estimate isn't changed again. The remaining $18 million would be recorded in 2019. Here for the year, the company debits compensation expense $16 million and credits paid-in capital stock options for the same amount. Assume that half the options in the illustration, 5 million shares, are exercised on July 11th, 2022, when the market price is $50 per share. To record this transaction, Universal Communications debits cash for $175 million, paid-in capital stock options for $40 million, and credits common stock for $5 million. The difference is recorded as a credit to paid-in capital excess of par of $210 million. Paid-in capital stock options becomes paid-in capital expiration of stock options when options expire without being exercised. Here, the company debits paid-in capital stock options for $40 million and credits paid-in capital expiration of stock options for the same amount. The stock option plans vest become exercisable on one single date, i.e. 4 years from the date of grant. This is referred to as cliff vesting. More frequently, though, awards specify that recipients gradually become eligible to exercise their options rather than all at once. This is called graded vesting. For instance, a company might award options that vest 25% the first year, 25% the second year, 50% the third year, or maybe 25% each year for 4 years. In such a case, the company can choose to account for the options essentially the same as cliff vesting plans we've discussed to this point. It can estimate a single fair value for each of the options, even though they vest over different time periods, using a single weighted average expected life of the options. Each vesting group, or tranche, is viewed separately, as if it were a separate award. At any given date, the company must have recognized at least the amount vested by that date. The allocation in this instance meets that constraint. The $23 million recognized in 2016 exceeds the $7 million vested. The $39 million, 23 plus 16, recognized in 2017 exceeds the $19 million vested by the same time. Companies can also choose to use the straight line method, which would allocate $49 million total compensation cost equally to 2016, 17, and 18 at $16.333 million per year. Concept check. Stock options and other share-based plans often specify a performance condition or a market condition that must be satisfied before employees are allowed the benefits of the award. The objective is to provide employees with additional incentive for managerial achievement. For example, an option might not be exercisable until a performance target is met. The target could be divisional revenue, earnings per share, sales growth, or rate of return on assets. The possibilities are limitless. On the other hand, the target might be market related, perhaps a specific stock price or a stock price change exceeding a particular index. The way we account for such plans depends on whether the condition is performance or market based. Whether we recognize compensation expense for performance-based options depends A, initially on whether it's probable the performance target will be met, and B, ultimately whether the performance target actually is met. Accounting as described earlier for other stock options. Initial estimates of compensation cost as well as subsequent revisions of that estimate take into account the likelihood of both forfeitures and achieving performance targets. Suppose we estimate that it is not probable sales will increase by 10% after 4 years. Then our estimate of the total compensation is 0. Suppose, though, after 2 years we estimate it is probable that sales will increase by 10% after 4 years. Then our new estimate of the total compensation would change to 80 million, and we would reflect the cumulative effect on compensation in 2018 earnings and record the compensation. Here, for the year 2018, Universal Communications debits compensation expense for 60 million, calculated as 80 divided by 3 times 3 divided by 4 minus 0, and credits paid-in capital stock options for the same amount. Similarly, in the year 2019, the company debits compensation expense for 20 million, calculated as 80 times 4 divided by 4, 1, minus 60, and credits paid-in capital stock options for the same amount. Plans with market conditions. If the award contains a market condition, for example, a share option with exercisability requirement based on the stock price reaching a specified level, then no special accounting is required. The fair value estimate of the share option already implicitly reflects market conditions due to the nature of the share option pricing models. So we recognize compensation expense regardless of when, if ever, the market condition is met. Decline in popularity of options. Recent years have witnessed a steady shift in the way companies compensate their top executives. In the wake of recent accounting scandals, the image of stock options has been tarnished in the view of many who believe that the potential to garner millions in stock option gains created incentives for executives to boost stock prices, though through risky or fraudulent behavior. That image has motivated many firms to move away from stock options in favor of other forms of share-based compensation, particularly restricted stock awards and increasingly restricted stock units. Also contributing to the rise of restricted stock is the feeling by many that it better aligns pay with performance from the executive's perspective. Restricted stock units is a more certain, though potentially less lucrative form of compensation. Employee share purchase plans often permit all employees to buy shares directly from their company at favorable terms. The primary intent of these plans is to encourage employee ownership of the company's shares. Presumably, loyalty is enhanced among employee shareholders. The employee also benefits because typically these plans allow employees to buy shares from their employer without brokerage fees and perhaps at a slight discount. Some companies even encourage participation by matching or partially matching employee purchases. As long as A, substantially all employees can participate, and B, employees have no longer than 1 month after the price is fixed to decide whether to participate, and C, the discount is no greater than 5% or can be justified as reasonable, accounting is straightforward. If these criteria for the plan, being non-compensatory, are met, accounting is straightforward. The sale of new shares is recorded as employee buy shares and do not record compensation expense. If the plan criteria for being non-compensatory are not met, say the discount is 15%, accounting is similar to other share-based plans. The 15% discount to employees then is considered to be compensation, and that amount is recorded as expense. Compensation expense replaces the cash debit for any employer-provided portion. Say an employee buys shares, no par, under the plan for $850 rather than the current market price of $1,000. The $150 discount is recorded as compensation expense. The purchase of shares at the 15% discount is recorded as a debit to cash for 850, a credit to common stock for 1000. The difference is recorded as a debit to compensation expense for 150, calculated as 1000 times 15%. We have revised the concept of earnings quality. We also have noted that rather common practice that negatively influences earnings quality is earnings management, which refers to a company's use of one or more several techniques designed to artificially increase or decrease earnings. A frequent objective of earnings management is to meet analysts' expectations regarding projections of income. If a manager's personal compensation includes company stock, stock options, or other compensation based on the value of the firm's stock, it is not hard to imagine an increased desire to ensure that market expectations are met and that reported earnings have a positive effect on stock prices. This is precisely the reaction that these incentive or compensation plans are designed to elicit. Investors and creditors, though, should be alert to indications of attempts to artificially manipulate income and realize that the likelihood of earnings management is probably higher for companies with generous share-based compensation plans. One way managers might manipulate numbers is to lowball the data that go into the option pricing models. The models used to estimate fair value are built largely around subjective assumptions. That possibility emphasizes the need for investors to look closely at the assumptions used as reported in the stock options disclosure note, and particularly at how those assumptions change from year to year. A typical corporate annual report contains 4 comparative financial statements, an extensive list of disclosure notes and schedules, and several pages of charts, tables, and textual descriptions. Of these myriad facts and figures, the single accounting number that is reported most frequently in the media and receives by far the most attention by investors and creditors is earnings per share. The reason for the considerable attention paid to earnings per share certainly include the desire to find a way to summarize the performance of business enterprises into a single number. Summarizing performance in a way that permits comparisons is difficult because the companies that report the numbers are different from one another. And yet, the desire to condense performance into a single number has created the demand for EPS information. The profession has responded with rules designed to maximize the comparability of earnings per share numbers by minimizing the inconsistencies in their calculation from one company to the next. The calculation of basic earnings per share is earnings available to common shareholders divided by the weighted average number of shares outstanding. The calculation becomes more demanding when A, the number of shares has changed during the reporting period, and B, when the earnings available to common shareholders is diminished by dividends to preferred shareholders, or C, when we attempt to take into account the impending effect of potential shares. The illustration shows the fundamental calculation of earnings per share. Earnings per share is the company's earnings of 154 million divided by the number of shares outstanding of 60 million. Here we get a basic earnings per share value of $2.57 per share. Because the shares discussed in illustration 19.5 remain unchanged throughout the year, the denominator of the earnings per share calculation is simply the number of shares outstanding. But if the number of shares has changed, it's necessary to find the weighted average of the shares outstanding during the period the earnings were generated. An additional 12 million shares had been issued on March 1st. We calculate the weighted average number of shares to be 70 million because the new shares were outstanding only 10 months, or 10 divided by 12 of the year. We increase the 60 million shares already outstanding by the additional shares, weighted by the fraction of the year. 10 divided by 12, they were outstanding. The weighted average is 60 plus 12 times 10 divided by 12 equals 60 plus 10 equals 70 shares. The reason for time weighting the shares issued is that the resources the stock sale provides to the company are available for generating income only after the date the shares are sold. So weighting is necessary to make the shares in the fractions denominator consistent with the income in its numerator. Stock dividend or stock split is a distribution of additional shares to existing shareholders. But there's an important and fundamental difference between an increase in shares caused by a stock dividend and from selling new shares. When new shares are sold, both assets and shareholders' equity are increased by the additional investment in the firm by shareholders. On the other hand, stock dividend or stock split merely increases the number of shares without affecting the firm's assets. In effect, the same price is divided into more pieces. The result is a larger number of shares, less valuable shares. The fundamental change in the nature of the shares is reflected in the calculation of earnings per share by simply increasing the number of shares. Unlike a sale of new shares, this should not be interpreted as a dilution of earnings per share. Shareholders' interest in their company's earnings have not been diluted. Instead, each shareholder's interest is represented by more, though less valuable shares. In the illustration, notice that the additional shares created by the stock dividend are not weighted for the time period they were outstanding. Instead, the increase is treated as if it occurred at the beginning of the year. The number of shares outstanding after a 10% stock dividend is 1.10 times higher than before. This multiple is applied to both the beginning shares and to the new shares sold before the stock distribution. If this had been a 25% stock dividend, the multiple would have been 1.25. A 2-for-1 stock split simply means a multiple of 2. Notice that earnings per share without the 10% stock dividend, $2.20, is 10% more than it is now with a stock distribution, $2. This is caused by the increase in the number of shares. If shares are reacquired during the period, either retired or as treasury stock, the weighted average number of shares is reduced. The number of reacquired shares is time weighted for the fraction of the year they were not outstanding, prior to being subtracted for the number of shares outstanding during the period. When stock distribution occurs during the reporting period, any sales or purchases of shares that occur before the distribution are increased by the distribution, but stock distribution does not increase the number of shares sold or purchased, if any, after the distribution. Let's modify our continuing illustration to assume 8 million shares were reacquired on October 1st as treasury stock. The 8 million shares reacquired as treasury stock are weighted by 3 divided by 12 to reflect the fact that they were not outstanding the last 3 months of the year. Let's compare the adjustment for treasury shares with the adjustment for new shares sold. Each is the time weighted for the fraction of the year the shares were or were not outstanding. But notice the differences. The new shares are added while the reacquired shares are subtracted. The second difference is that the reacquired shares are not multiplied by 1.10 to adjust for the 10% stock dividend. The reason is that the shares were repurchased after the June 17th stock dividend. The reacquired shares are 8 million of the new post-distribution shares. Concept check. The denominator in an earnings per share calculation is the weighted average number of shares outstanding. Logically, the numerator should be similarly represented earnings available to common shareholders. This was automatic in our illustrations to the point because the only shares outstanding were common shares. But when a senior class of shareholders, like preferred shareholders, is entitled to a specific allocation of earnings, like preferred dividends, those amounts are subtracted for earnings before calculating earnings per share. In the illustration, preferred dividends are subtracted from net income so that earnings available to common shareholders is divided by the weighted average number of common shares. Preferred dividends of $4 million, calculated as 8% of $10 par times 5 million shares, is deducted from the net income of $154 million. In this case, the basic earnings per share is calculated to be $2. Concept check. Securities such as these convertible bonds, while not being common stock, may become common stock through their exercise or conversion. Therefore, they may dilute, reduce earnings per share, and are called potential common shares. A firm is said to have a complex capital structure if potential common shares are outstanding. Besides convertible bonds, other potential common shares are convertible preferred stock, stock options, and contingently issuable securities. We'll discuss each of these shortly. A firm with a complex capital structure reports two earnings per share calculations. Basic earnings per share ignores the dilutive effect of such securities. Diluted earnings per share incorporates the dilutive effect of all potential common shares. Stock options, stock rights, and stock warrants are similar. Each gives holder the right to exercise their option to purchase common stock, usually at a specified exercise price. The dilution that would result from their exercise should be reflected in the calculation of diluted earnings per share, but not basic earnings per share. To include the dilutive effect of a security means to calculate earnings per share as if the potential increase in shares already has occurred, even though it hasn't yet. So for stock options or rights or warrants, we pretend these options have been exercised. In fact, we assume the options were exercised at the beginning of the reporting period or when the options were issued, if that's later. We then assume the cash proceeds from selling the new shares at the exercise price are used to buy back as many shares as possible at the share's average market price during the year. Stock options give their holders, company executives in this case, the right to purchase common stock at a specified option price, $20 in this case. When we simulate the exercise of stock options, we calculate earnings per share as if 15 million shares were sold at the beginning of the year. This obviously increases the number of shares in the denominator by 15 million shares, but it is insufficient to simply add the additional shares without considering the accompanying consequences. Remember, if this hypothetical scenario had occurred, the company would have had 300 million from cash proceeds from the exercise of the options, 15 million shares times $20 exercise price per share. In our illustration, the stock options do not affect the calculation of basic earnings per share. 15 million shares issued minus 12 million shares reacquired, 300 million times $25 per share equals 3 million net increase in shares. The way we take into account the dilutive effect of stock options is called the Treasury Stock Method because of our assumption that Treasury stock shares are purchased with the cash proceeds of the exercise of the options. Concept check. Sometimes corporations include a conversion feature as part of a bond offering, a note payable, or issue of preferred stock. Convertible securities can be converted into, exchanged for, shares of stock at the option of the holder of the security. For that reason, convertible securities are potentially dilutive. Earnings per share will be affected if and when such securities are converted and new shares of common stock are issued. In the previous section, you learned the potentially dilutive effect of stock options is reflected in diluted earnings per share calculations by assuming other options were exercised. Similarly, the potential dilutive effect of convertible securities is reflected in diluted earnings per share calculations by assuming they were converted. By the if converted method, it's called, we assume the conversion into common stock occurred at the beginning of the period or at the time the convertible security is issued, if that is later. We increase the denominator of the earnings per share fraction by the additional common shares that would have been issued upon conversion. We increase the numerator by the interest after tax on bonds or other debt or the preferred dividends that would have been avoided if the convertible securities had not been outstanding due to having been converted. Let's return to our continuing illustration and modify it to include the existence of convertible bonds. The convertible bonds do not affect the calculation of basic earnings per share. We increase the denominator by the 12 million shares that would have been issued if the bonds had been converted. The bond interest expense, 10% times $3 million equals 30 million, would have been saved, causing income to be higher. But by saving the interest paid would also have meant losing a $30 million tax deduction on the income tax return. With a 40% tax rate, that would mean paying 12 million more in income taxes. So to reflect the earnings, the 18 million after-tax interest would have been avoided in the event of conversion. We add back the 30 million of interest but deduct 40% times 30 million of the higher tax expense. Concept check. The potential dilutive effect of convertible preferred stock is reflected in the earnings per share calculation in much the same way as convertible debt. That is, we calculate earnings per share as if conversion had already occurred. Specifically, we add shares to the denominator of the earnings per share fraction. We do not subtract the preferred dividends in the numerator because those dividends would have been avoided if the preferred stock had been converted. In the illustration, we assume that preferred stock is convertible into 3 million shares of common stock. The adjustment for the conversion of the preferred stock is applied to only diluted earnings per share calculations. Basic earnings per share is unaffected. Since diluted earnings per share is calculated as if the preferred shares had been converted, the preferred dividends of $4 million in the numerator is not subtracted. Concept check. At times, the effect of conversion or exercise of potential common shares would be to increase rather than decrease earnings per share. These we refer to as anti-dilutive securities. Such securities are ignored when calculating both basic and diluted earnings per share. Options, warrants, rights. In applying the Treasury Stock Method, the number of shares assumed repurchased is fewer than the number of shares assumed sold. This is the case in many times the buyback average market price is higher than the exercise price. Consequently, there will be a net increase in number of shares, so earnings per share will decline. On the other hand, when the exercise price is higher than the market price, to assume the shares are sold at the exercise price and repurchased at the market price would mean buying back more shares than were sold. This would produce a net decrease in the number of shares. Earnings per share would increase, not decrease. These would have an anti-dilutive effect and would not be considered to be exercised. To assume 4 million shares were sold at the $32.50 exercise price and repurchased at the lower market price of $25 would mean acquiring 5.2 million shares. That's more shares than were assumed sold. Because the effect would be anti-dilutive, we would simply ignore the warrants in the calculations. For convertible securities, it's not immediately obvious whether the effect of their conversion would be dilutive or anti-dilutive because of the assumed conversion would affect both the numerator and denominator of the earnings per share fraction. We discovered each was dilutive only after including the effect in the calculation and observing the result, a decline in earnings per share. But there's an easier way. To determine whether convertible securities are dilutive and should be included in a diluted earnings per share calculation, we can compare the incremental effect of the conversion expressed as a fraction with the earnings per share fraction before the effect of any convertible security is considered. If the incremental effect of a security is higher than basic earnings per share, it is anti-dilutive. For comparison, we determine the earnings per share, earnings per incremental share of the two convertible securities, bonds and preferred stock. Recall from the previous illustration that basic earnings per share is $2. The incremental effect of conversion of the bonds is the after-tax interest saved of 18 million divided by the additional common shares from the conversion, 12 million. Since the incremental effect of bonds is 150 is less than the basic earnings per share of $2, it is dilutive. Similarly, the incremental effect of the conversion of the preferred stock is the dividends that wouldn't be paid, dividend of 4 million, by the additional common shares from the conversion of 3 million. Since the incremental effect of preferred stock is $1.33 is less than the basic earnings per share, it is also dilutive. A convertible security might seem to be dilutive when looked at individually, but in fact may be anti-dilutive when included in a combination with other convertible securities. This is because the order of entry for including their effects in the earnings per share calculation determines by how much or even whether earnings per share decreases as a result of their assumed conversion. Because our goal is to reveal the maximum potential dilution that might result, theoretically we should calculate diluted earnings per share using every possible combination of potential common shares to find the combination that yields the lowest earnings per share, but that's not necessary. The earnings per share incremental share can be used to determine the sequence of including securities effects in the calculation. We include the securities in reverse order, beginning with the lowest incremental effect, that is, the most dilutive, followed by the next lowest, and so on. In calculating the diluted earnings per share, when stock options are outstanding, we assume the options have been exercised. That is, we pretend the company sold the shares specified by the options at the exercise price and that the proceeds were used to buy back, as treasury stock, as many shares as can be purchased at the average market price of the stock during the year. The proceeds for the calculation should include the amount received from the hypothetical exercise of the options, 300 million in the earlier chapter, but that's only the first of three possible components. The second component of the proceeds of the total compensation from the award. That's not yet expensed. If the options had been fully vested, all the compensation would have been expensed, and this second component of the proceeds would have been zero. If the options have only been half vested, half the compensation would have been unexpensed, and the remaining half would be added to the proceeds. The third component of the proceeds is what's called the excess tax benefit. We expense the fair value of the stock options at the date of grant. If the options were non-qualified options rather than incentive stock options, the corporation receives a tax deduction at exercise equal to the difference between the stock's market value and the exercise price. That amount usually is higher than the fair value of the options at the grant date, and the difference times the tax rate is the excess tax benefit. If the options were incentive stock options, no tax benefit is provided. The proceeds include everything the firm will receive from the award: 1. Cash, if any, at exercise; 2. Services from the recipient, value of the award given at compensation; and 3. Tax savings. The reason we exclude the expense portion is that when it's expensed, the earnings are reduced, and that dilution is reflected in earnings per share. Excluding that expense portion from the proceeds avoids the additional dilution that would occur if more proceeds were available in our hypothetical buyback of shares. Hence, we avoid double counting the dilutive effect of the compensation. Let's discuss the components of proceeds in the Treasury Stock Method using an example. The proceeds for the calculation should include the amount received from the hypothetical exercise of the options, which in this example is 300 million, calculated as 15 million common shares times $20 exercise price. This is the first of three possible components. The second component of the proceeds is the total compensation from the award that's not yet expensed. It's the fair value of the option had been $4 at the grant date. The total compensation would have been 15 million shares times 4, or 60 million. In our example, we assumed the options were fully vested before 2016. Therefore, all 60 million already had been expensed, and this second component of the proceeds is zero. If the options had only been half vested, half the compensation would have been unexpected, and 30 million would have been added to the 300 million proceeds. The third component of the proceeds is what's called the excess tax benefit. In our example, we assume that the options were incentive stock options, hence no tax benefit. Restricted stock awards and restricted stock units are quickly replacing stock options as the share-based compensation plan of choice. Like stock options, they represent potential common shares, and their dilutive effect is included in diluted earnings per share. In fact, they too are included using the Treasury Stock Method. That is, the shares are added to the denominator and then reduced by the number of shares that can be bought back with the proceeds of the average market price of the company's stock during the year. Unlike stock options, though, the first component of the proceeds usually is absent. Employees don't pay to acquire their shares. Also, only unvested restricted stock award shares and restricted stock unit shares are included in the hypothetical earnings per share calculations. Fully vested shares are actually distributed and thus are outstanding. The proceeds for the earnings per share calculation include the total compensation from the unvested restricted stock that's not yet expensed, the second component. For example, refer back to the restricted stock in the previous illustration. The total compensation for the award is 60 million, $12 market price per share times 5 million shares. Because the restricted stock vests over 4 years, it is expensed as 15 million each year for 4 years. At the end of 2016, the first year, 45 million remains unexpensed, so 45 million would be the assumed proceeds from an earnings per share calculation. If we assume the market price remains at $12, the 45 million will buy back 3.75 million shares, and we would add the denominator of diluted shares, EPS, of 1.25 million common shares. At the end of 2017, the second year, 30 million remains unexpensed. So assuming the average market price again is $12, we would add the denominator of diluted shares, EPS, 2.5 million common shares. Sometimes an agreement specifies that additional shares of common stock will be issued contingent on the occurrence of some future circumstance. At times, contingent shares are issuable to shareholders of an acquired company, certain key executives, or others in the event of a certain level of performance is achieved. Contingent performance may be desired level of income, a target stock price, or some other measurable activity level. When calculating earnings per share, contingently issuable shares are considered to be outstanding in the computation of diluted earnings per share. If the target performance level is being met, assumed to remain at existing levels until the end of the contingency period. For example, if shares will be issued on a future date if certain level of income is achieved, and that level of income or more was already reported this year, those additional shares are simply added to the denominator of the diluted earnings per share fraction. For clarification, we refer to the continuing illustration of diluted earnings per share and assume 3 million additional shares will become issuable to certain executives in the following year, 2017, if net income that year is 150 million or more. The net income for Sovereign Financial in 2016 was 154 million, so the additional shares would be considered outstanding at the computation of diluted earnings per share by simply adding 3 million additional shares to the denominator of the earnings per share fraction. Obviously, the 2017 condition, 150 million net income or more, has not been met yet since it's only year 2016. But because that level of income was achieved in 2016, the presumption is that it's likely to be achieved in 2017 as well. If the target income next year is 160 million, the contingent shares would simply be ignored in the calculations. If the disclosure note reproduced in the illustrations for Hunt Manufacturing Company reported contingent shares in connection with its acquisition of Feeney Manufacturing Company. Under certain circumstances, securities that have the potential of reducing earnings per share by becoming common stock are assumed already to have become common stock for the calculation of earnings per share. The table in the illustration summarizes the circumstances under which the dilutive effect of these securities is reflected in the calculation of basic and diluted earnings per share. The illustration summarizes the specific effects on diluted earnings per share fraction when the dilutive effect of a potentially dilutive security is reflected in the calculation. When calculating earnings per share in our example, we pretended the convertible bonds had been converted at the beginning of the year. What if they actually had been converted, let's say on November 1st? Interestingly, diluted earnings per share would be precisely the same. Here's why. The actual conversion would cause the actual increase in shares from the date of conversion bonds are converted. These would be time weighted to the denominator would increase by the fraction. The numerator would be higher because the income actually would be increased by the after-tax interest saved on the bonds. We would assume conversion for the period before conversion because they were potentially dilutive during that period. In the first case of the calculation is shown when the bonds are not actually converted. In the second case, it's considered that the bonds are converted on November 1st. The actual conversion would cause an actual increase in shares of 12 million on November 1st. These would be time weighted, so the denominator would increase by 12, 2 divided by 12. Also, the numerator would be higher because the net income actually would be increased by the after-tax interest saved on the bonds for the last 2 months. 30 minus 40% times 30 times 2 divided by 12. Be sure to note that this would not be an adjustment to the earnings per share calculation. Instead, net income would actually have been higher by 30 minus 40% times 30 times 2 divided by 12, or equal to 3. That is, reported in the net income would have been 157 rather than 154. We would assume conversion for the period between November 1st because they were potentially dilutive during that period. The 12 million shares assumed outstanding from January 1st to November 1st would be time weighted for that 10-month period. 10 divided by 12. Also, the numerator would be increased by the after-tax interest saved on the bonds for the first 10 months. 30 minus 40% times 30 times 10 divided by 12. Notice that the incremental effect on earnings per share is the same either way. The illustration shows the disclosure note for Clorox Company reported after the conversion of convertible notes during the year. Recall that if a company disposes of a component of its operations, the company will report discontinued operations as a separate item within the income statement. When the income statement includes discontinued operations, earnings per share data, both basic and diluted, must also be reported separately for income from continuing operations and net income. Per share amounts for discontinued operations would be disclosed either on the face of the income statement or in the notes to the financial statements. Basic and diluted earnings per share data should be reported on the face of the income statement for all reporting periods presented in the comparative statements. Businesses without potential common shares present, basic earnings per share only. Presentation on the face of the income statement is illustrated by the partial income statements of H&R Block Incorporated from its annual report for the year ended April 30th, 2014, and exhibited in the illustration. Disclosure notes should provide additional disclosures, including a reconciliation of the numerator and denominator used in the basic earnings per share computations to the numerator and denominator used in the diluted earnings per share computations. Any adjustments to the numerator for preferred dividends, any potential common shares that weren't included because they were anti-dilutive, any transactions that occurred after the end of the most recent period that would materially affect earnings per share. Disclosure notes should provide a reconciliation of the numerator and denominator used in the basic earnings per share computations to the numerator and the denominator used in the diluted earnings per share computations. An example of this is presented in the illustration using the situation described in a previous illustration. Recognition of deferred tax asset for stock options under U.S. GAAP. A deferred tax asset is created for the cumulative amount of the fair value of the options the company has recorded for the compensation expense. The deferred tax asset is the tax rate times the amount of compensation. Under IFRS, the deferred tax asset isn't created until the award is in the money. That is, it has intrinsic value. When it is in the money, the addition to deferred tax asset is the portion of the intrinsic value earned to date times the tax rate. Plans with the graded vesting with options have graded vesting. U.S. GAAP permits companies to account for each vesting amount separately, but also allows companies the option to account for the entire award on a straight line basis over the entire vesting period. Either way, the company must recognize at least the amount of the award that has been vested by that date. Under IFRS, the straight line choice is not permitted. Also, there is no requirement that the company must recognize at least the amount of the award that has been vested by the reporting date. Option values have two essential components, intrinsic value and time value. Intrinsic value is the benefit the holder of an option would realize by exercising the option rather than buying the underlying stock directly. An option that permits an employee to buy $25 stock for $10 has an intrinsic value of $15. An option that has an exercise price equal to or exceeding the market price of the underlying stock has zero intrinsic value. Time value. In addition to their intrinsic value, options also have a time value due to the fact that A, the holder of an option, does not have to pay the exercise price until the option is exercised, and B, the market price of the underlying stock may yet rise and create additional intrinsic value. All options have time value so long as time remains before expiration. The longer the time of expiration, other things being equal, the greater the time value. For instance, an option with an intrinsic value of 15 might have a fair value of, say, 22 if time value still remains until the option expires. The $7 difference represents the time value of the option. Time value can be subdivided into two components, the effects of the time value of money and the volatility value. Option pricing models make assumptions about the likelihood of various future stock prices by making assumptions about the statistical distribution of future stock prices that take into account the expected volatility of the stock price. One popular option pricing model, the Black-Scholes model, for instance, assumes a log normal distribution. This assumption posits that the stock price is likely to fall by half as it is to double, and that large price movements are less likely than small price movements. The higher a stock's volatility, the higher the probability of large increases or decreases in market price. Because the cost of large decreases is limited to the option's current value, but the profitability from large increases is unlimited, an option on a highly volatile stock has a higher probability of a large profit than does an option on a less volatile stock. The variables that affect an option's fair value and the effect on each are indicated by the illustration. Stock appreciation rights overcome a major disadvantage of stock option plans that require employees to actually buy shares when the options are exercised. Unlike stock options, these awards enable an employee to benefit by the amount the market price of the company's stock rises without having to buy shares. Instead, the employee is awarded the share appreciation, which is the amount by which the market price on the exercise date exceeds a specified price, usually the market price at the date of grant. For instance, if the share price rises from 35 to 50, the employee receives $15 cash for each stock appreciation right held. The share appreciation usually is payable in cash, or the recipient has the choice between cash and shares. The share appreciation is usually payable in cash, or the recipient has choice cash and shares. A plan of this type is offered by IBM as described in the illustration. In some plans, the employer chooses whether to issue shares or cash at exercise. In other plans, the choice belongs to the employee. Who has the choice determines the way it is accounted for. More specifically, the accounting treatment depends on whether the award is considered an equity instrument or a liability. If the employee can elect to settle in shares of stock rather than cash, the award is considered to be equity. On the other hand, if the employee will receive cash or can elect to receive cash, the award is considered a liability. The distinction between share-based awards that are considered equity and those that are considered liabilities is based on whether the employer is obligated to transfer assets to the employee. A cash SAR, stock appreciation rights, requires the transfer of assets and therefore is a liability. A stock option, on the other hand, is an equity instrument if it requires only the issuance of stock. When an SAR is considered to be equity because the employer can elect to settle the shares in stock rather than cash, we estimate the fair value of the SARs at the grant date and accrue the compensation to expense over the service period. Normally, the fair value of an SAR is the same as the fair value as a stock option with the same terms. The fair value is determined at the grant date and accrued to compensation expense over the service period, the same way as it is for other share-based compensation plans. The total compensation is not revised for subsequent changes in the price of the underlying stock. When a stock appreciation right is considered to be a liability because the employee can elect to receive cash upon settlement, we estimate a fair value of the SARs and recognize the amount as compensation expense over the requisite service period, consistent with the way we account for options and other share-based compensation. However, because these plans are considered to be liabilities, it is necessary to periodically re-estimate the fair value in order to continually adjust the liability and corresponding compensation until it is paid. Be sure to note that this is consistent with the way we account for other liabilities. The periodic expense and adjustment to the liability is the fraction of the total compensation earned to date by recipients of the stock appreciation rights based upon the elapsed fraction of the service period reduced by any amounts expensed in prior periods. Case 1, illustration, considers stock appreciation rights to be equity because Universal can elect to settle the shares in Universal stock at exercise. On January 1st, 2016, there is no entry recorded. Total compensation of $80 million is calculated as estimated fair value of the stock appreciation rights of $8 multiplied by stock appreciation rights granted of $10 million. The value of the award is expensed over the service period for which the compensation is provided. The total compensation allocated to expense over the 4-year service vesting period 2016 to 19 is calculated as $80 million divided by 4 years, or $20 million per year. For December 31st, 2016 to 19, the company debits compensation expense for $20 million, calculated as $80 million divided by 4 years, and credits paid in capital stock appreciation right plan for the same amount. In case 2, the stock appreciation rights are considered to be liability because the employees can elect to receive cash at exercise. On January 1st, 2016, there is no entry recorded. The value of the compensation is estimated each year at the fair value of the stock appreciation rights. On December 31st, 2016, the company debits compensation expense for $21 million, calculated as $8.40 times $10 million times 1 divided by 4, and credits liability stock appreciation right plan for the same amount. The expense each year is the current estimate of the total compensation that should have been recorded to date, less the amount already recorded. On December 31st, 2017, the company debits compensation expense for $19 million, calculated as 8 times $10 million divided by 2 divided by 4 minus the $21 million already recorded, and credits liability stock appreciation right plan for the same amount. Similarly, on December 31st, 2018, the company debits compensation expense for $5 million, calculated as $6 times $10 million times 3 divided by 4 minus $21 million minus $19 million, and credits liability stock appreciation right for the same amount. If the fair value falls below the amount expensed to date, both the liability and expense are reduced. On December 31st, 2019, the company debits liability SAR plan for $2 million and credits compensation expense also for $2 million, calculated as $4.30 times $10 million times 4 divided by 4 minus 21 minus 19 minus 5. Compensation expense and liability continue to be adjusted until the stock appreciation rights expire or are exercised. On December 31st, 2020, the company debits compensation expense for $7 million, calculated as $5 times $10 million times all minus 21 minus 19 minus 5 plus 2, and credits the liability stock appreciation rights for the same amount. It is necessary to continue to adjust both compensation expense and the liability under stock appreciation rights. Ultimately, either are exercised or lapse. Assume, for example, that the stock appreciation rights are exercised on October 11th, 2021, when their fair value is $4.50. The executives choose to receive the market price appreciation in cash. Here, on October 11th, 2020, the company first debits liability stock appreciation plan for $5 million and credits compensation expense for $5 million, calculated as $4.50 times 10 million times all minus 50. In the next part of the transaction, the company debits liability stock appreciation plan for $45 million, calculated as $50 million minus the $5 million, and credits compensation expense for the same amount. Let's look at the changes in the liability stock appreciation right plan account during 2016 to 2021 period. The liability is adjusted each period as changes in the fair value estimate causes changes in the liability. At the end of 2021, the balance in the account after the exercise is zero. Recall from our discussion in the chapter that restricted stock units, RSUs, give the recipient the right to receive a set number of shares of company stock after the vesting requirement is satisfied, but sometimes the recipient is given the cash equivalent of those shares instead. If the employee will receive cash or can elect to receive cash, as in the case of a stock appreciation right, we consider the award to be a liability. We determine its fair value at the grant date and recognize that amount as compensation expense over the requisite service period. And, like stock appreciation rights payable in cash, we periodically adjust the liability and the corresponding compensation based on the change in the stock's fair value until the liability is paid. Accounting for restricted stock units payable in cash is quite similar to accounting for the stock appreciation rights payable in cash. In case 2, illustration of 19B-2. Of course, we would label the liability restricted stock unit, and we would determine the periodic value of the liability and compensation as the actual fair value of the shares rather than the estimated fair value as necessary when valuing stock appreciation rights. This is the end of Chapter 19.